Hey there, welcome to the Common Sense Show. And I have special guest David Garofalo today, and I'm excited to talk about gold investing. There's a lot of folks out there who are trying to diversify their investment portfolios now who listen to the Common Sense Show. And I understand that some of you are invested in real assets, real property. Some of you are small business or medium business owners, founders, entrepreneurs, and you're looking to grow your investment. Perhaps you have a little bit of Bitcoin, maybe you have some cash holdings, maybe you're invested in bonds. Hopefully your money is not in SVB. That's a whole nother conversation for another day. But today we're going to talk about investing in precious metals. Now I know what you're thinking. It's 2023, and how does precious metal actually line up to what your goals are? We're going to talk to David Garofalo, Chief Executive Officer and Chairman of Gold Royalty, today about that. He has a wonderful story. He's an interesting man, and I'm excited to get this thing going. So let's get him in and learn about him and learn more about Gold Realty. Hey, David, welcome to the Common Sense Show.
Thanks, Mike. I'm delighted to be here.
Awesome. So just a little bit about you. You are the Chief Executive Officer, President, Chairman, and Director. So essentially, you're the guy. You're the chief cook, and everyone comes to you for every single reason at Gold Royalty. So you've been globally recognized as a chief executive with over 30 years of experience in creating and growing multi-billion-dollar sustainable mining businesses, which is a fascinating thing because we don't always come across someone with experience in mining. So I want to dig into that a little bit. You've also been senior vice president, finance, and chief financial officer and director of, correct me if I'm wrong, Agnico Eagle.
That's correct.
That right?
Yeah.
Good thing I took those English classes. I scored A. I was A in English class from 1998 to 2010. And then you've also had various financial roles in other mining corporations. What's your favorite part of your job? What you do, would you say?
Building mines. What's really interesting about building mines is you're finding something on the ground of significant value, that economic value people didn't realize existed in the first place. So there's the exploration phase. There's the phase where you make the investment case for what's generally a very capital intensive business, high barriers of entry. You're having to raise many millions and billions of dollars in order to build a mine. And then you're creating sustainable value over a long period of time, generally in communities that lack investment. Mines generally are not found in urban centers. They're found in very remote parts of the world where there are very poor communities, and you're creating generations of value for those communities and for the governments in terms of tax revenues, a fiscal base, and creating infrastructure in communities where none exists generally. So it's really attractive socially for me. I think it's almost been a social cause for me more than an economic one. Because over the course of my 33-year career, I've built over 15 mines and in many remote parts of the world, many continents in the world, and created significant value. Many of those mines are still operating, creating value. And I imagine that it's created opportunities for many generations of the children of those initial families that we engaged with when we built those mines to get post-secondary education, become professionals, and raise their standard of living, not only within the local community, but in the broader country as well.
Yeah, that's interesting because everyone I've seen who interviews you doesn't start there. They typically jump right into the investment piece and they want to talk about the tangibility of gold. But what you said about mining gold in particular seems a little contraindicated to what probably people think and believe about mining and its contribution to the workforce that actually engages with working in the mine, to the general local community. Why do you think that those misconceptions exist?
Well, historically, mining's had a terrible environmental reputation. And I think by and large, that's passed, particularly among the well-capitalized companies in the world. They couldn't raise capital. They couldn't be listed on a stock exchange unless they were responsible environmental stewards. And these days, in order to get a social and environmental license and a government permit in order to build a mine, you also have to be able to file a closure plan and provide bonding up front before you actually put a shovel in the ground to provide the assurance not only to the government but the local community that you're going to be there upon the closure of the mine, because these are finite life assets. Eventually, they're exhausted, but you're there to basically reinstate the property back to its original state prior to the exploitation of those minerals. But listen, every economy, every developed economy in the world, if you think of the most developed nations in the Western world, have started with a thriving primary industry. You can't have a secondary and tertiary industry unless you have a primary industry that provides that foundational element to your economy. And that's true of the United States, it's true of Canada, that's true of every developed country in the world. They started by developing the resources in the ground that they had. And then they built an economy, a sustainable and mature economy with secondary and tertiary industries on top of that. It's countries that try to skip that step that generally don't provide sustainable economies nor sustainable governance models.
So, how have you been able to provide generational? Is the generational wealth that you're talking about, or generational opportunity that you've spoken about, for the individuals who are working at these mines, have they come just from becoming wealthy from working at the mine? Is it about wealth in general, or is it just the fact that these jobs have existed for multiple decades because that's the life cycle of a mine?
Yeah, so there's a couple elements of it. I mean, as I said earlier on, a lot of mines tend to be built in very remote parts of the world where there's generally agrarian economies, not sustainable economies, ones that have existed for multiple generations, but really haven't grown beyond that. And we're providing high-paying jobs, number one. And we like to draw from the local communities when we're building mines because that's much more economically sustainable and socially sustainable for the mine. It's a responsible thing to do, both economically and socially. But then what it does is creates opportunities for their children to go to schools. We tend to build infrastructure in the communities because we want to draw on them. So we want to have schools, we want to have hospitals and whatnot. So we're providing better healthcare, providing better access to education. And ultimately, a lot of those kids end up going to universities they wouldn't have otherwise been able to, because you're operating in an agrarian economy and a very self-isolated and self-sustaining economy in these agrarian areas, and you're not providing the opportunity for those younger generations to break out and pursue professions or other trades or whatnot. So we're creating jobs locally, but we're also creating the economic opportunity for those second, third generations of our workers to go off to get educations elsewhere.
How does David Garofalo get into mining? You don't wake up one day, go to math class, take algebra, English, and say, you know what, mining, that's the thing I want to do for the rest of my life. Like, how did you even get introduced to this concept?
I completely fell into it. I was a 22-year-old, recently minted CPA working at Deloitte's. We were talking about one of your friends that works at Deloitte's in Boston, but I started with Deloitte's, did my CPA in the late 80s. Actually, I didn't even have any mining clients. I was doing financial services, the big banks. I was doing big retail on the audit side, and decided I really didn't want to have or pursue an accounting profession. I did my CPA. It gave me the foundational elements to pursue a business career and the education I needed. And a headhunter called me with an offer of a very junior accounting position in a mining company. And I said, well, I don't know anything about mining. He says, you don't need to. You need to crunch numbers and produce financial statements. I said, well, I can do that. I'll do that for a couple of years, and I'm sure I'll go find something else that will be more interesting. And what I found was mining is fascinating. As I said, you create value out of nothing. It's highly capital intensive. So you're continually in the market raising money, and then you're taking that capital and marshaling it to build these big industrial complexes in remote parts of the world, creating that kind of economic benefit and opportunity for those local communities and governments. And you're in a continuous cycle of replacing depleting assets. So you're continually raising capital, deploying capital. And so it's an exciting, dynamic business. And I really fell in love with it. And after a couple of years of crunching numbers and doing financial statements and projections and whatnot, the company I was with was starting to build mines. And they said, well, we need some financial expertise to do feasibility work and then go out for bid on major contracts, construction contracts. We need people that are commercially oriented to help with that. So I joined a mine building team and built several mines with my first employer, then joined Agnico Eagle in 1998. We built 6 mines there. And then I ran Hudbay as CEO for 6 years, a copper producer, built 3 mines there, and then ran Goldcorp, one of the biggest gold producers in the world, and built a number of mines there. And all in all, been involved in the construction of 15 mines. And I have to say it's addictive. That process of raising capital, putting it to work, creating value is a highly addictive and highly satisfying aspect of my job.
And so how easy or hard is it to actually raise capital for this particular venture? I mean, it's a non-traditional, well, saying non-traditional is actually not entirely true, given that gold has been around for thousands of years. But in the sense of an investment vehicle for a person who's investing capital, and I'm assuming royalties, which we'll get to in a minute, in person looking for a return on their cash, how do you convince them to, like, I'm gonna invest in a mine to build, and then this is gonna pay me back? Like, what's that process like?
No, it's a great question, and it's a very cyclical industry, which is to say that sometimes the capital is there, sometimes it's not. When metal prices are high, then you tend to find generalist equity investors willing to throw capital at mining companies with growth opportunities. And I would say over the last half a dozen years, that hasn't been the case. It's been very, very selective access for mining companies to build new mines. And it really starts with the geological model. You have to be able to demonstrate that the deposit is attractive economically. It has enough mineral in it that makes it worth exploiting. Then you have to make the investment case. It generates an adequate rate of return for the capital you need to invest, which tends to be quite often in the hundreds of millions or billions of dollars. Again, very high barriers of entry. Right. And so I would say it's been very selective access over the last half a dozen, 10 years. That's likely to change as metal prices start to gather some momentum and generals start to participate in mining equities again. And then probably it'll become easier again, but there's a cyclicality to it. But it really starts with the fundamentals, really from the ground up, quite literally making the case for the investment in the new mining opportunity.
That's fascinating. With this current sensitivities with environmental interactions between humans and the general environment, whether a career or an industry has been historically interactive between humans and the environment, governments are cracking down. You're in Canada. I mean, it's one of the most environmentally protective countries, I mean, out there. I mean, I know America's trying to get there, but what's the interaction like with the government? How do you convince them? Do you find now that it's harder than it ever has, the justifications, the timing for permitting, getting the mines constructed?
Yeah, it's never been longer. In fact, from discovery of a new deposit to first production is typically a 15 to 20 year cycle.
Oh my God.
Yeah, it's very, very long. So I talked about the barriers to entry being more the capital intensity, but it's also the timelines.
Right.
Imagine how difficult it is to make an investment case for something that's 15 to 20 years away from generating revenue. So it's a challenge. And there's a number of factors that really drive those elongated timelines. One is, of course, you have to make a good fundamental case for the geological deposit. You have to drill it out. That quite often is constrained by access. If the deposit is going deeper, you need to start to tunnel deeper in order to get the drill setups to define it geologically, make that investment case. That takes time, takes capital. And then you have to get a social license to operate. And, quite often you're dealing with First Nations communities or Indigenous communities, or you're just dealing with communities at large. Community engagement is community engagement, whether they're First Nations or not. And that's required longer timelines as well. You have to consult with the local communities. Then you have to go through a regulatory process, which, if anything's become more cumbersome and more duplicative, because quite often it's not one level of government, it's multiple levels of government, from municipal up to federal. And quite often they're duplicating efforts. They're not coordinating their efforts. You're having to do them over and over again. So it's become less efficient as I think, I'd hazard to say that these governments tend to do a lot of CYA, right? And, so that's why they tend to duplicate efforts rather than try to coordinate their efforts. So it has become challenging, and it's become challenging at precisely the time that we need these metals more and more than ever, because if we hope to decarbonize our economy, we need a lot of metal to do that. And I'll give you a very tangible example. If you want electric vehicles by 2035, as our governments have mandated that we're going to all be driving the EVs by 2035, we need a lot of copper. A copper, or an electric vehicle uses about 600 pounds of copper each. In a traditional internal combustion engine uses a third of that. So we have to triple the copper intensity per vehicle. I have zero idea of where all this copper is going to come from. So when I hear these governments, including our own federal government, wave their magic wands and say we're all going to be driving EVs by 2035, they're either disingenuous or completely ignorant of what supply chains are.
And yeah, I lean on the side of the disingenuous and the and them just trying to get reelected. I've said this. What's so funny? It's so funny that you say this because I've said this to people. I said to myself, I'm like, yeah, 2035, huh? You mean after they push it back another 30 to 40 years? Because that's what's going to happen. They put it out there for them to get reelected. Yeah. There's not going to be the raw materials for them to be able to accomplish their goals. And number one, there is going to be a massive glut, dare I say half of the majority of people who simply can't afford to transfer their vehicle from gas powered to electrical. And fossil fuels are obviously the most efficient fuel source that we have. And that kind of shows itself in the fact that people who struggle financially can still buy those cars and fuel them up to get to work just to maintain a stasis. How you get there with them having to convert that to electric vehicle, even with tax credits, is so pie in the sky to me. But that's a whole nother conversation.
And that's one example of our decarbonization effort. But for example, electrical power generation, we can't hope to achieve net zero emissions without uranium. We need to go back to nukes, and nukes are zero emission. And guess what? Most of the uranium comes from Russia. There are no producing uranium mines in the United States.
Yeah.
My business partner, Amir Adnani, runs a uranium company, Uranium Energy Corp. Mm-hmm. He's the only one that has actually brownfield uranium mines ready to go in the U.S. Wow. And it's not easy. It's very, very challenging to get these things back up and running. And so there's no domestic supply chain for nuclear reactors in the U.S., but the U.S., if it hopes to achieve its net zero emissions on its electrical grid, needs a lot of nukes, and they need a lot of uranium to get that. Do they want to rely on the Russians? I don't think so.
Yeah, well, exactly. And in addition to that, they have the political will to be able to bring in nukes. I mean, the fact that people also, you have the politicians that kind of rally against nuclear energy, and it's like, you can't have it all. They try to have it all ways, but it's the whole let them eat cake kind of thing, I guess. But but you're absolutely right. So gold. Let's talk about this. So one of the hurdles, actually, I just thought about. Sorry, I'm slightly ADD, so I kind of bounce around a little bit. But one of the things I'm thinking about is, okay, so the government makes you hard for you to get in for the various reasons that you said, but then you say the word GOLD. And it turns people from supporters to thieves, I bet. And everybody wants to put their fingers on what you're doing. Have you found that over the course of your career?
Yeah, look, there's a mystique around gold because, as you correctly pointed out, it's been a currency. It's been the only sustained currency for 4 millennia. Every fiat currency that's ever been invented since the beginning of time has ultimately failed. And I would guarantee you that all the fiat currencies that exist today will ultimately fail, including the U.S. dollar. Yeah. The temptation is just too great to debase the value of those things. They just keep printing them, and eventually they're worth nothing. The value of the U.S. dollar has fallen 90% since it abandoned the gold standard in the early 1970s. Yeah. So there clearly has been a proliferation of U.S. dollars introduced that flooded into the system. So gold. The other thing about gold is it's been recognized as a currency for 4,000 years, but it's also recognized as a currency in every nation in the globe. Yeah. I would say that you could walk into any city, in any town, in any rural community, anywhere in the world with gold, and people understand the intrinsic value of that gold. Every human on this planet understands the value of gold. Right. If you went into those same communities, remote ones, with a piece of paper currency in your hand, 9 times out of 10, they won't even accept it. Mm-hmm. That's true even of the U.S. dollar. I'm sorry. It's not a universally recognized currency in every part of the globe. Right. It's worth no more than the toilet paper that people have. So to them, because there isn't any physical value. There's no intrinsic value. Can't do that with Bitcoin.
Yeah.
That you can't do that with any of the 8,000 cryptocurrencies that have been introduced since the proliferation of the cryptocurrency. It's a fiat currency like any other currency. If you create
Absolutely.
one out of thin air, it's a
Yeah.
fiat currency. The US dollar was invented out of thin air.
Right. That's right. And
And
you're
so,
absolutely relying on the person behind you to value it more than you do currently.
yeah,
And gold just has it has a worldly value that's just like you said, it's just been around forever. And
yeah,
I mean, its ubiquity in terms of the value
precisely.
of its just tradability. It's amazing. So that made me think about something actually. I guess it kind of answers a question, which is that a lot of people might push back on this idea of precious metals, given that there are some more efficient means of investment vehicle now than there ever have been in human history. Things like crypto, like real property, because of we can go into debt service now, unlike people could do back then.
Yeah.
Years ago, a person who's upper middle to middle class can buy a home in America today. That necessarily wasn't the case previously. You had to have more capital. You didn't have access to all these debt service vehicles. But precious metals in 2023, right? Some people might say, well, David, I get you with the gold and the building of the mines and, building communities. But from an investor standpoint, here I am. I want to put my hard-earned money that I spent 20, 30 years. I don't necessarily trust the government, but at the same time, I've never considered precious metals as a vehicle to actually put money into. What say you?
Well, I would say that if you look at any investment opportunity, there has to be an underlying intrinsic value to what you're investing in. Otherwise, it's just air. It's just momentum, and it disappears. Eventually, it disappears. We saw that in the technology sector in the early part of this century when we had the dot-com craze. There just wasn't any intrinsic value or underlying value in a lot of those businesses, and it blew up. And eventually, the businesses that did have intrinsic value, had sustainable businesses, they found value in the market. Whether it's the Apples and the Googles and the whatnot, they have a business model. They generate revenue. They create economic value. They generate profits. So there has to be an underlying value in what you're investing. Otherwise, it's just a momentum play, and momentum plays definitely run out of gas at some point. I'd say that's by and large the case with many of these cryptocurrencies that have been introduced in the system, because there's no intrinsic value. There's no business associated with those. They're a fiat currency. They're a means of trading, but there's too many of them. And there is room in the world for digital currencies as a means of bartering and trading, but not for 8,000 of them. And not for, if your Uncle Ted can invent a cryptocurrency, where's the value in that? That's just, it's just basically capturing the momentum that and the speculative bubble that exists in that market and has existed for the last several years. Gold is the one currency that can't just be created out of thin air. And I think it's important to really understand how scarce it is, how precious it really is. There's only 200,000 metric tons that have been mined since the beginning of time. And to give you a sense of what that looks like volumetrically, it fits into an Olympic-sized swimming pool. It's tiny.
Wow.
So it's not a lot. It's a very small fraction of 1% of the investable assets globally. So you can imagine a small reallocation of capital, reweighting of capital into gold could drive gold to stratospheric highs, ones that we haven't seen before and we're currently experiencing now. So we see significant upside there, but it's that intrinsic value, that physical property, its indestructibility, its recognition of currency as a currency for 4,000 years, the fact that it's not anybody's obligation. The US dollar is the obligation of the US government, whereas gold is nobody's obligation. And that's what makes it universally attractive as an investment vehicle across the world, and recognized as such because it's incorruptibility. Whereas fiat currencies are being corrupted, have been corrupted time and again over the centuries. And there's many ways to play gold that there weren't historically. You had to buy physical gold back in the day. That's the only way, and you had to store it somewhere under your mattress in a safety deposit box, whatnot. You can still do that, and I still see value in owning physical gold. But you can also now buy an ETF that's physically backed. It's traded on the New York Stock Exchange on the trading symbol GLD. The gold's held at the Bank of New York on your behalf. You buy a share of the GLD, it's 1/8 of an ounce. So you've got physically backed ETF. So there's an easy way to play it on your mobile phone, and that's why I think cryptocurrencies have taken off so much is because of the advent of the smartphone. There's a new generation of investors that come into the market, understand instinctively that their fiat currencies are being undermined, and they're looking for an alternative. And the cryptocurrency was created to provide that opportunity. And it's easily investable on your smartphone.
Yep.
Well, you can do gold on your smartphone right now. There are digital tokens backed physically by gold that you can buy on your smartphone. So gold is adapting, and the industry is adapting to provide more fungibility, more investability, more vehicles to invest in gold than they ever have before. And then there's the mining equities and all of that as well, which we can talk about over the course of the conversation. But there's ways to play the physical gold through more modern means than we've seen historically.
So I think that's a great segue to how, if you're a beginning investor, how you can dip your toe in the gold. There are very few American banks now that you walk in and you can plop down a pallet of cash and get a bar of gold now, unlike before. But ETFs, exchange traded funds, are a really great way to invest. I must make a disclaimer because my lawyer says that this is just for education and information only. This is not financial advice. So I'm not endorsing one specific investment vehicle, not even David's, even though he's a fascinating, interesting man with a wonderful product, but I don't endorse it. So there's that disclaimer out the way if you think about bringing me to court. But here's what I will say is that ETFs are great, obviously, because of the liquidity, the ability to become liquid, and which is kind of the same reason why people invest in gold. Liquidity, right? You have it. You can sell it if you want. You can maintain it. It goes up in value. It also goes down, of course. But ETFs. Now, let's talk about this for a second. You're saying gold specific ETFs versus combined precious metal ETFs, right? That include things like silver, copper, obviously gold, right? I mean, they have those ETFs as well. But how would you be if you were starting in 2023? You're watching this, you're 18 to maybe even 40 and you've never invested in precious metals. How would you begin right now?
Yeah, look, the easiest way and the most understandable way is actually buying physical gold. You don't have to buy bars; you can buy coins. The U.S. Mint sells coins. You can do it online, and it's pure gold, and you can store it in your safe at home or safety deposit box at your bank. There's nothing wrong with that. I have a small gold wafer up on my wall behind me. Sorry, I'm blocking it. There he goes. It's framed in gold there. I got it when I left Agnico Eagle to go around Hud Bay. They gave me a little gold wafer, and I guess in the case of an emergency, I break the glass and I'll go buy some bread. But look, I like having physical gold as well. Right. You can buy the ETF as I talked about. That's a little bit more efficient. The storage costs you get some economies of scale because they store a lot of gold. So you don't have to incur as much in storage costs. And then you can start to look at mining equities. In theory, the reason you would do that is they should provide you leverage to the gold price. And what I mean by that is if the gold price goes up 10%, from say $2,000 an ounce to $2,200 an ounce, then the value of your gold holdings go up 10%. But if you own a mining equity and their profit margins are, 40 or 50%, if gold price goes up 10%, then their profit margins should go up maybe 30 or 40%. You get leverage, right?
Interesting.
And they should outperform the gold price as a result of that leverage. Unfortunately, we're in an inflationary environment, and mining companies are not immune from that. So their cost structures are not necessarily stable. So leverage only works if the costs stay the same and the margins expand.
That's right.
But right now, they're struggling with cost inflation. Labor and energy costs are going up astronomically for all of them.
Right.
And so that's kind of undermined the leverage proposition that you would get from a mining equity. So that's why I'm running a royalty company. It's a roundabout way to explain why I've transitioned from building and operating mines and run operating companies for my entire career to running a royalty vehicle. Because what a royalty company does is it gets paid royalties on the gross revenue from a mine. So we own royalties on the mines.
Genius.
Yeah, and so we don't care about their operating costs and capital cost inflation because we're not exposed to that. We provide capital to the operators and explorers and developers, and rather than take repayments back, we take a royalty back on the mine in perpetuity. So
Oh my God.
that gives us not only a percentage of their gross revenue over the reserves that they currently own, but if they explore and add to their reserves, which typically they do, we get
Mhm.
the benefit of that upside without paying for it. It's the gravy. And that's
Unbelievable.
really what supercharges our returns. And again, insulates our shareholders from cost inflation. It gives us optimum leverage to the gold price, optimum leverage to the expiration without having to pay for it.
Yeah.
At Gold Royalty, we own 217 royalties,
Yep.
and they're all bought and paid for. We never
Mhm.
have to put another dime in them. Once we own them forever, and they give our shareholders infinite optionality to the expiration on those properties.
Unbelievable. So if you're watching this and you're trying to understand what David is saying, essentially it's the franchise model in gold. Franchise model, you're getting a royalty off of gross receipts. Almost always, I own a franchise. I know how it works. And you don't have to worry about OpEx. Like it's brilliant. And okay, so let's talk about how long those royalties last on average per mine. Is it something like, well, in the franchise model, I have 10-year agreements, so I know that I'm getting a royalty on gross for 10 years. How long do these mines last?
Could be decades. We have 217 royalties. We have 3 royalties that are on the 3 biggest producing gold mines in North America:
Yeah.
Canadian Malartic in Quebec, Côté in Ontario, and Goldstrike, the underground extension of Goldstrike in Nevada. And those assets have 30 plus years of reserves ahead of them, but many of them have been operating for decades up to this point. Um,
Wow.
so these could be multi-decade, multi-generational deposits. We're very fortunate. We have 3 foundational assets like that. They're going to be generating revenue long after I'm gone.
Yeah.
For our shareholders. And that's the attractive part of our vehicle. It's not just about throwing a bunch of royalties against the wall to see what sticks. We have some really, really chunky, long life, low cost operations with very well capitalized operating partners, some of the biggest in the world. In fact, they are the biggest in the world. Barrick and Newmont run Goldstrike. Agnico Eagle runs Canadian Malartic. These are
Right.
the 3 biggest producing gold companies in the world, and
Right.
they're our operating partners. So I know these mines are always going to be well run, environmentally responsible, and well capitalized.
The genius in what you've built, and it's more where you position yourself, I think, than anything else, which is that we talked about at the beginning of the conversation that one of the biggest hurdles that mine operators have to overcome is the fact that they need capital intensive investment in order to break into these mines, in order to actually get there, and the return might not come for years, so they're always looking for capital partners. And so by creating a fund essentially where you can bring people in to help invest in these mines, and with the exchange of them just giving you a royalty on top of you providing them capital for this mine that's going to open eventually, it's going to open, but eventually, and leveraging the resource of your experience, of course, and your knowledge about where and what and who's in charge and all the other stuff. I mean, it's really a smart play. How in the world did you come up with this? Did you not? Maybe you didn't come up with it. Maybe you saw it and you enhanced the model. But tell me a little bit about that. How did you say, okay, this is my roost. I'm gonna perch here, because to me it's a brilliant model. If you can get the capital enough where they're interested, of course, to have you come in. But of course, obviously, you're doing that. So
Yeah, no, look, I definitely did not pioneer the model. It was actually pioneered by the chair of my advisory board, Ian Telfer, who created one of the biggest royalty and streaming companies in the world, Wheaton Precious Metals, 15 years ago out of my old company, Goldcorp. He spun it out. He wrote some royalties on their existing operations, created a royalty vehicle, spun it out. And guess what? Wheaton Precious Metals became bigger than its mother company eventually, because it's such an attractive model. Again, it gives you that top line exposure, insulates you from cost inflation. Running mines is hard. It's highly risky. It's capital intensive, a lot of inflation risk, a lot of technical risk. Running royalty companies is easy, very scalable business. I run a business with 8 full-time equivalent employees. We share some resources with some other companies. And I could run a company 10 times the size with 2,000 royalties with the same employees. Eminently scalable business, low operating costs. So every incremental dollar of revenue growth falls right to the bottom line, increases our ability to pay dividends. It's a great model from that respect. And so I did not pioneer the model. What we've endeavored to do, though, is start to consolidate some of the smaller players in the space. Since we IPO'd over 2 years ago, we've consumed 3 other of our competitors and growing our
Okay.
business very quickly. The idea being, if we create scale, it lowers our cost of capital,
Of
increases our
course.
trading liquidity, lowers our
Yep.
cost of capital. This is a cost of capital driven business where you pointed it out. We're a bank or a fund.
Yep.
We're
Mhm.
effectively a bank that's specifically focused on the mining business, and we're
Absolutely.
putting capital to work and taking a royalty back in return as a repayment. But
Mhm.
it provides us a big kicker, whereas lending doesn't. You get your
Right.
interest, you get your principal back. We get our interest and our principal back, and then we get the expiration upside, which really provides the juice.
Yeah. Yeah. No, that's I only wish that there was a mine down the street that I could invest in. I think it's freaking awesome. What I have questions. So what oh, I hate when this happens. I drew a blank. I can assure you that it was going to be both brilliant and witty at the same time as entertaining. But it was specifically about dividends. So how long have you been paying dividends and what's your schedule?
Yeah, so we've been paying dividends since 10 months after our IPO.
Mhm.
So I think we've had 7 quarters of dividends. So we're quite a young company, just over 2 years old.
Mhm.
And we pay a penny per quarter,
Mhm.
and that's equivalent to about a 1.8% yield currently.
Okay.
But we have 60% CAGR, compounded annual growth in our revenue over the coming years, right through the end of this decade.
Mhm.
And that, as I said, given our G&A is flat, we have 8
Yeah.
full-time equivalent employees. It's not going up.
Right.
Every dollar of incremental revenue means probably incremental dividends as well. That's
Yeah.
our game plan, is to raise the dividend over time as we crystallize that revenue growth. And again, all of that revenue growth is completely bought and paid for. All we have to do is
Right.
harvest now. We don't have to
Yeah.
put another dime in.
Yeah. No, it's smart. And then if you think about the Warren Buffett strategy he learned from Ben Graham, which is find a company with competent management, look at the balance sheet and look at the financials of the operating model. The fact that you don't have operations expenses other than your administrative expenses, you're building a royalty model based off of that is, I mean, how in the world do you compete with that in the sense that, you have these royalties coming in from these investments strategically placed you already have the key industry relationships given your experience in the industry. Are you still with me?
Yep.
Oh, there you are. Okay.
Yep.
But so it makes a ton of sense what you're doing. So okay, so a person listening to this, what they're going to do is they're going to go check out gold ETFs. They're going to perhaps buy gold coins online. They're going to come to Gold Royalty, and what they're going to find is what? How do they? What do you have a minimum investment level into your
No,
fund?
look, we're an NYC American traded stock under the
Okay.
trading symbol GROY, GROY.
Mhm.
So very easy to buy. We're probably trading around, I think, 215 per share right now.
Yep.
So
What was
really,
your IPO?
where did we IPO? On
Yep.
the NYC American.
Okay. What was it?
We raised $90 million US,
Okay.
and our market cap currently is about $350 million US.
Awesome. Okay. So trade. So and they can your ticker can be found on. It can be found on Cash App. Is it on Robinhood, Cash App? All the current modern ways to.
I presume. I'm going to
It
take
better be, David.
I'm going to take it from a younger generation of investors. I do, I can readily find it on my online broker.
Right.
It's a very liquid stock. We trade, on average about $1.4 million of stock per day on the NYC American. So relatively liquid stock, easy to trade in and out of. Trade many hundreds of thousands of shares per day. So.
Right. And so when I talk about investments, generally, no matter what the vehicle is and how a person is diversifying, I often talk about investing in things that you both know and that you believe in, because those are the things that actually make sense. I think you've established the fact that gold has trust over the centuries, over the millennia, in fact, with humans. And it's obviously easy to know it's a precious metal. How finite a resource is gold right now? What are the future prospects for mining gold? Because perhaps an investor who's looking at, obviously investing is going to want to know what does the future look like for mining gold?
Yeah, no, it's a great question, because I think the concern might be, well, if gold takes off, which I think it will in this inflationary cycle that we're currently experiencing, is there going to be a flood of new supply that will squelch the rally in the gold price? And I would say, in fact, that's the opposite of the case, because of the long lead times from
Yeah.
discovery to production. We can't just flick a switch and bring on new supply. And
Right.
in fact, the industry has not been reinvesting back in exploration over the last decade or so. And reserves in the ground, unmined reserves, are down 40% from their peak in 2012 because of the lack of reinvestment in exploration. So there isn't the ability to just introduce new supply, and capacity utilization in our industry is at about 99%. So there aren't any like idle
Oh,
mines waiting to come back on in response to a much higher gold price. So
right.
like as I quite often say, there's an incredible inelasticity of
Mhm.
gold supply to price just because of the impediments, the capital intensity, the lead times, the lack of exploration. There's a last inelasticity of supply to price, and so that's hugely supportive to the gold price because there isn't going to be that flood that'll curtail a rally.
Yeah. So what's the off-market gold market like? Are there countries right now buying up gold supply, and what is that doing to the price of gold?
Yeah, look, in fact, central banks are the biggest consumer of gold right now.
Mhm.
And I would say the biggest central bank buying is coming from the developing world: China, Russia, Turkey. The countries that deal with significant export markets have an avalanche of foreign currency proceeds. And there's no opportunity cost of owning gold right now. If you think about it, real interest rates are negative.
Yeah.
Yeah, sure. The Federal Reserve has brought up interest rates 400 basis points in the last year, but
Mhm.
inflation's 7%,
Yeah.
8%. So that means real rates are negative. So there's no opportunity cost of owning gold. And central banks get that.
Mhm.
They're saying, well, geez, if the US is printing, which they have been to stave off another financial contagion, they're bailing out banks again.
Right.
Well, if they're undermining their own fiat currency as central bank in China, I don't want to own the U.S. dollar.
Mhm.
I've got a natural long in the U.S. dollar by virtue of all of the exporting I'm doing into the U.S. market. So I better diversify out of that as quickly as I possibly can. And what currency will I want to own in this environment where there's negative real interest rates? Well, the Chinese government's saying, I'll own gold because it can't be
Yeah.
manipulated. And so China is not only the biggest producer of gold in the world, they're the biggest consumer of gold in the world as a country. And
Mm.
so they consume everything they produce, and they're the
Mhm.
biggest importer of gold. So they're consuming everything they produce, and they're importing as much, hoovering up as much as they can of the world's gold supply because they're diversifying out of the renminbi, out of the US dollar as quickly as they can to bolster the central bank reserves. Russia's been doing that. Turkey's
Yep.
been doing that. Venezuela's been doing that. All these countries that are having difficulty getting liquidity are instead owning gold in order to protect their central bank reserves.
Look at Brazil. I mean, how quick did they shift to try to make Bitcoin the national currency, and now they're trying to get from under the US dollar from being the reserve currency, and they're shifting to the side of Russia and China right now and partnering with them.
Well, and
Um,
China recognizes that if they want to truly create an alternative reserve currency to the US dollar, they need
mhm.
to have backing of something with intrinsic value. That's why they're buying gold. The biggest owner of gold in the world as a central bank is, guess what? The US.
Interesting.
It has been because they were the standard bearer for the U.S. gold standard or for the gold standard until the
Right.
early 1970s. So they had accumulated significant central bank reserves. Franklin Delano Roosevelt confiscated all physical gold
He did.
during World War II, and he
Yeah.
kept it.
Yeah.
And as a result, the U.S. by far has the biggest store of gold in the world as a central bank. And as a result, China looks at that and says, well, one of the reasons the US dollar has been recognized as a reserve currency all these years is because of that physical backing. Even
Yeah.
though it's not formally backed, it's still there. They never sold any ounces of US central bank reserves.
Right.
China recognizes in order to be legitimized as an alternative reserve currency, they're going to need to own a lot of physical gold as well.
Right. That is a strong argument, in my opinion, also for why gold is uh, a key investment right now because um, of what China's doing right now. I think that's a really strong to a thinking person. I think that's a really strong argument. I mean, I don't know if we'll have another FDR situation where he's having men and women and children mill their gold to the U.S. government, their jewelry, so that they can turn it into gold bars. But I think that for sure, um, that's a strong argument with regard to why the stability of gold isn't really going anywhere. That makes a lot of sense to me. Um, David, how can our viewers, listeners, reach out to your company. You're a very busy man. I don't want to flood your inbox with a glut of questions, but how would someone listening to this podcast, for instance, learn more about your strategy, about Gold Royalty, which you all are doing, and of course, ultimately, we know how they can invest. They can invest on an investment platform, but any suggestions for them?
Yeah, so our website's goldroyalty.com. We're on LinkedIn, we're on Twitter, all the social media platforms and whatnot. But goldroyalty.com, we have a newsletter as well you can sign up for if you're looking for regular news updates. We just recently published our ESG report, our annual ESG report, our inaugural one, that I think demonstrates how carefully we look at our supply chain to ensure that we are operating in a responsible way, both environmentally and socially, and from a governance standpoint. We published our asset handbook as well. So if you want to get into a bit more granular detail into the 217 royalties we own, you can look at our asset handbook on our website and get access to that. Sorry about that.
No, it's okay. Someone got excited about the asset handbook. Yeah, no, that's great. That's great. Thank you for that. It's funny. I was thinking about how even myself, I was watching an interview with Robert Kiyosaki, and one of the things that he was talking about, he's like, I don't trust the government. I don't trust the government. I don't trust the government, which is basically his reasons for investing in precious metals for the last 35 to 40 years or so. Probably a good reason to actually invest in precious metals, to be honest with you. But I think at the end of the day, you make some strong points about where currency is going, the fact that fiat currency ultimately almost always fail. And there's no reason why the US dollar would be immune to that. And just by way of diversification and bolstering your portfolio, it makes so much sense to invest in precious metals that have the history and the desire for countries and individuals alike to actually own. It makes a lot of sense. Thank you for sharing your operational model, and thank you for kind of letting us into the world of gold mining today and how people can invest in gold. I'm wondering, is there anything that I didn't ask you about gold and investing that I probably should have, that I left off the table?
My gold price call. You didn't ask.
I should have. You're right. You're absolutely right. Sorry about that.
Yeah, look, I'm going to put out a number that some people might think it's outrageous, but I don't think it is. $3,000 an ounce. Gold's at 2,000 right now. It's just above 2,000. It's near its all-time high, which is just under $2,100 an ounce. But that's the nominal high, not the real high. The real high is what we experienced in the early 1980s, right during the middle of the previous big inflation cycle. And gold was about $850 an ounce in 1981. And if you inflation adjust that to 2023, that's $3,000 an ounce.
Wow.
So entirely achievable, believable. And I would argue that the inflation cycle that we're currently experiencing is far more entrenched and far worse than we had back in the 1970s, because back then we had a lot less debt globally. We had 100% debt to GDP globally in the 70s. Today we have 350%. So there's very limited latitude for the central banks to really raise interest rates to tame inflation. The Federal Reserve is going to pivot hard, and they're going to cut rates because you know what? They need to inflate the debt away. They can't repay it. There's no fiscally responsible way for any of these governments to repay their debt. U.S. debt service right now is $1 trillion a year. It's one out of every $7 raised in tax revenue.
It's unbelievable.
If they raise interest rates another couple hundred basis points, it would double to $2 trillion.
But I don't think people really know how close to screwed everyone really is. And COVID did no favors. It
was the match that lit a very, very dry forest. Yeah. But the forest had been dry for a while because right from the great financial crisis, when we've been flooding the market with liquidity from 2008, these accesses have been introduced over almost 2 decades now. And it's not going to be unwound overnight with a few tightenings of a nominal interest rate. And I use the word disingenuous before to talk about government's environmental standards, but I would say the central banks are being quite disingenuous in raising rates, because if they were really serious about taming inflation, rates would already be above headline inflation numbers. They're not, and they're not going to even approach that. Paul Volcker, when he ran the central bank, the Federal Reserve back in the 70s and 80s, he brought interest rates to 20%. I remember my first mortgage was double digit. Okay. Wow. And that's when headline inflation numbers were 14%. So he had a mandate, and he saw it through, and he brought inflation to heal in the early 1990s, and we had 20 years of price stability, and that was unwound by the great financial crisis.
I think that it's going to end up bolding. I think bolding well for gold, because if you think about it, they're going to have to relax standards on things like their environmental requirements for mining, so that they can produce as fast as possible. The government's job is to get production up for these natural resources and produce elements that are natural, that they can't inflate and they can't print their way out of. And
so, Mike, I'll just correct you on one thing. I do not want the governments to relax environmental standards whatsoever. I just want them to be a little bit more efficient in their permitting process. The standards are there; they don't need to be watered down whatsoever. And mining companies have learned their lesson. They don't want to create environmental disasters. They don't want to leave back environmental legacies that are poor. They just want a more efficient process to get their permits and to engage locally with communities to get the social license. It's a highly inefficient process right now. And, when I hear Joe Biden talk about getting to net zero and then not issuing a mining permit anytime in his history, it's very, very frustrating for me as a miner. You have to have a fundamental understanding of your supply chain if you hope to achieve the government policies you want to achieve, the environmental standards you want to achieve. You need to produce the metal, and you have to have a plan to do that. There is no plan. That's the problem.
Yeah, you would think that the another thing that COVID would have taught us is supply chain management and supply chain compliance and supervision and supply chain nurturing. I mean, supply chain nurturing, number one. I mean, it is crucial that we bring significant manufacturing back to North America in general. It's way too far and way too expensive. I'm the CEO of a manufacturing company right now. We manufacture a wood and silicone product, and it's a building material. And to get our product to like Australia, to source our part of our we use a Chilean pine for the product. It's unbelievable. I mean, the fact that we were able to source it from different lumber yards around the country, but for a while it had gone extinct, and we were trying to source it, and the price was astronomical. I mean, not as high as metal had gone during COVID, but I mean, it was really crazy. But I mean, I think so thank you for the correction, and it makes a lot more sense now that you say that. Is if you just become more efficient, they could probably cut it down from 15 years to what, 3, 2?
Yeah, I mean, really, ideally 5 years is more than enough time to get through the red tape. It should be more than enough time to file an environmental remediation plan, to get the social engagement done. And again, only if the governments were more efficient, at various level governments cooperated with each other. I think we all want to achieve the same end result of net zero emissions, but we need a lot of metal to do that.
Yeah, that makes a lot of sense. David, thank you for your time today. I appreciate it. And I think your level of passion for what you do is obvious. I think that your strategy is clear, and it makes a lot of sense. And I think that if people who are listening today follow your advice, or even follow your journey and what you all are doing, they're going to be on the right track, because you know what you're doing. So thank you for coming on today. I appreciate it.
Thank you, Mike. I was delighted to be here.
All right. So that was David Garofalo from Gold Royalty. He is amazing. As you heard, the company that he created are doing, I mean, huge things. I mean, I think that it's absolutely genius the way his company has positioned itself in the gold marketplace. So if you're thinking about investing in gold, he gave you some very easy things that you can do to do it. You can buy it online. You can buy a gold ETF. You could buy a royalty, buy some stock in Gold Royalty, and grab yourself some royalties. As long as those mines exist and are producing, I think it's a wonderfully simple way to get started. Well, thank you for tuning in today. I appreciate it. And remember, if you don't go to work on your business, you're going to go to work on the business of someone else. Until the next time, I'm Micah. I'll talk to you later. Bye.